Bruce, thanks for having us here at Midtown West. Appreciate it.
Thank you, David. Great to be here.
The views are incomparable. They really are beautiful. I want to talk about Brookfield as a whole, and obviously your Investor Day, in which you're going to be introducing some important targets for those investors. The one that caught my eye, assets under management. Over the next 5 years, we should be able to organically grow to $2 trillion. What gives you the confidence over the next 5 years that you can get to that number?
Look, I think you need to just step back and think about two big trends that are happening in capital markets in the world. And the first one is private markets. And the second one is just the growth of capital in the world and the compounding of wealth. Sovereign funds, institutional wealth funds are just getting bigger and bigger, and they need things to put that into. And more private capital is where they want their money to be. So all the alternative products that we offer them because they don't have liquidity, they get a better return. But more importantly, I think there's less distraction in the private markets.
What does that mean?
Just every day when you're quoting the bond markets are up, the equity markets are down, and all those things are happening out there, if you're an investor, it's just a distraction. What people own when they buy our stock or they buy anything in the public markets is they own an underlying business. The value keeps going like this often, but the price goes up and down. And that distraction is what institutional investors want to get out of the markets. And now that's transforming from both institutions, but it's also going into retail. And individuals want to participate in the same things, and we're creating products to be able to do that. So,
right, I mean, you know, our viewers are familiar with BREIT, for example, from Blackstone, but there are any number of other vehicles now, and you're creating and have created some of them as well, that allow the retail investor to access the private markets in a way that they couldn't previously.
Yeah, look, I'd say we've spent a lot of time creating very methodical, bespoke products. So we have listed entities for renewables, infrastructure, the trade in the public markets. People can buy them. They're perpetual vehicles, and they continue to grow over time. We're creating semi-liquid products very methodically within the business. But all those things are really just taking the things we do for institutional clients, repackaging them so that we can offer them to high net worth. And so all of those, to go back to your original question, all of those...
The $2 trillion question?
Yeah, all of those things are just a tailwind on the alternative space. And we're one of the largest in the world. And therefore, as we continue to build out these products, there's just a lot of capital that's interested in earning the returns that we can deliver them. And
without the distraction, in a sense, of a public market equity.
Yes, I think it's just, and that's often that's under appreciated, but the distraction is what is really helpful. I'm going to earn a 9% yield, or I'm going to earn 15, and I'm going to do it over a long period of time, and I'm going to compound wealth, and do not get distracted, because the distractions make you think I should sell, or they make you think I should buy, or you're unclear as to what you should do. And so private markets that's why a big part of money's flowing to private markets.
Well, we've noted, and I have noted in my reporting, obviously, the growth of private markets. It's not as though they haven't been with us for some time, but over this last, let's call it 5-year period, they seem to have exploded. You seem to believe that is a trend that is here to stay.
This is not stopping. It's actually accelerating. And part of it is just the money that's piling up in the world. And many of these sovereign funds have 300, 500, 700, 800, $1 trillion, $1.3 trillion. These are large sums of money, and you just can't put that in the stock market. So they need to find good investors to put the money to work, and we're putting it into private assets in renewables, transition, real estate, credit, and all these private equity businesses on a private basis.
Right. But again, I should point out, this is organic. So this is growth organically, not through acquisition, although you don't rule out the possibility of acquisition. Obviously, you've done one, Oaktree being an example.
Yeah, look, there are some times we can find best-in-class managers. Oaktree was we felt one of the best credit managers out there. We partnered with them. We own 70% of it. The team owns 30%. They are best in class. We help them where we can. but they run their business, and it's been highly additive to the organization in many ways. So we don't rule that out again, but remember, these are people businesses. You have to be very, very careful with people.
What does that mean?
Just it's you need to pick your partners right. You need to take care of them. You need to provide them capital, and over time you need to be, it's just like having your own people in your organization.
Right.
You need to take care of them.
Speaking of the different areas, of course, of investment, and I'm looking here in terms of your renewable power and transition infrastructure, obviously good old private equity and real estate, which have been with us for some time, and credit. Where do you think, to the extent there is more of an opportunity? I mean, AUM, you're obviously the smallest AUM is renewable power and transition. Is that the one that you think will grow the most?
Look, it was part of our infrastructure business before. We split it apart because there's three things going on in the world today. I'll call them megatrends. The decarbonization of the world, so taking carbon out of the system, deglobalization, and the biggest one that is out there is the decarbonization of the world. And so we took our renewables business, we separated it from infrastructure, we created a fund, we raised a fund last year, or 2 years ago, with Mark Carney as the head of it, and it's for decarbonization. And what we're doing, it's a $15 billion fund, and we're out raising a second one now. And what we're essentially doing is providing money to companies, or assisting them have less carbon within their system. That's all.
How are you doing that?
It's not good.
Right.
We're not making decisions as to whether things are good or bad or black or green. We're just providing money.
So it's not an ESG product, for example.
Look, it sort of is, but remember, we're not making any judgments. What we're trying to do is help companies have less carbon. So an example, many of the technology businesses in the world have committed to net zero very quickly. What they need is renewable power. So we are building them renewable power in many countries in the world. So we're one of the largest builders. We're one of the largest owners of renewable power, and we're building solar and wind in 15 countries in the world. And we're providing that to them. And before, you used to sell power into the grid. Today, we're actually selling it to the corporate customers, and they're using it within their systems. The AI build out of data centers is all, or wants to all, be renewably powered, and we're providing renewables for them. In addition to that, for example, we're providing money to companies that need to invest to get carbon out of the system. So we're helping a company in California doing carbon sequestration. We're buying a business in Australia which is going to use our capital over the next 10 years to shut down their coal plants and to turn it into renewable power. So
how are you structuring these deals? I mean, are they all different based on the needs of the borrower and/or end user of the cash, or do they share something similar?
So I would say they're all bespoke transactions, and I guess the increasingly what these large institutions and why companies come to us is because we can provide a buyout, we can provide a partnership, we can lend money. And so we have all of those activities that we can provide on a scale basis. Not many people can provide $500 million, $1 billion, $2 billion, $5 billion, $10 billion. With Intel, we recently committed to half of a $32 billion facility in Arizona, you may recall.
I do. I want to discuss that a bit as well, because I'm not sure people realize how instrumental you were in their ability to, or at least their plan to build all these fabs.
Yeah, and look, it's just people need, our goal is be a solutions provider on a global basis in the industries that we participate in. And if people need debt, we'll do it. The partnership we just did with Société Générale yesterday is to essentially have senior money in the structure. So now we can provide senior money. We can always provided mezzanine money in real assets, but also structured paper, and also we can do a buyout and own assets ourselves.
Right, right. But you don't have to have control. Clearly, and that's the case a lot, you don't have control.
Look, many of the businesses that we buy, we're in control, and we're a 100% control investor. But increasingly, we're here to help our partners our counterparties achieve the goals that they require, and which means that we provide non-control money through our structured solutions business and debt for either mezzanine or senior paper.
Well, it sounds like the renewables business is going to grow quickly. I don't want to put words in your mouth. Is that your expectation?
This is probably the largest infrastructure build-out ever seen over the next 25 years. We are going to take most of the energy system for electricity. Forget oil. Oil's in cars and planes and those kind of things. But for electricity,
for generation. Right,
and we're going to convert most of that energy to solar wind. And that's a massive build-out that's going to happen, and we're at the heart of it just because of our historical roots as a business operator.
How did the passage of the what is still called the Inflation Reduction Act impact, if at all, the way you think about allocating capital in this area?
You know, look, we own a lot of things, and we bought a lot of them prior to that, not because it was we knew it was coming, but we benefited from that a lot. What it essentially means is that if somebody had a bunch of projects and they expected 50% of them would get built out, because of the Inflation Reduction Act, 75% will get built out, which just means that we're going to compress more projects into less time, and that's good for business. Right. And it's going to get more renewables built out in America.
And what kind of returns are you typically targeting, particularly in the interest rate environment in which we live now?
Yeah, so look, our on the low end of debt products, which would be the lowest type of returns that we get, mezzanine debt products are in the circa 9-10% return. And our equity investments, which we target higher returns, are close to 20. You know, our real estate strategies have earned 20% compound for 20 years. Our private equity business, 28% compound for 20 years. Infrastructure, close to 15. These are high returns. And on transition, we're going to do good and also do well. And we don't have to compromise returns to get returns out of this business.
Is it a lower return business, though, than some of the others you just mentioned?
It's over time it's been slightly lower. Although I think our returns will get better over time.
Why?
just because of the build out and the need for capital out there, and so I think the returns are going to get better from here.
Speaking overall, given your view into so many different businesses in the economy, how are you feeling about things right now? We seem to have reached potentially a stasis in rates, but it doesn't mean in any way that they're coming down anytime soon. What are you sort of seeing and feeling and expecting as this year ends and next year begins?
Look, David, I think the interest rates stabilizing is what was needed. What worried most investors was that interest rates were going to go like this. For some unforeseen reason, nobody thought it was going to happen, but people worried it might. And just stabilized rates is bringing. Over the last 3 months, you've seen the capital markets everywhere in the world start to open back up. Banks are opening back up, and that's a big positive for business transactions and for business overall, and that's certainly happening today.
So you're happy to live with a higher rate environment as long as it's not one where rates are increasing at a rapid rate?
Look, I think we'll see rates are here. They're probably settled down a little bit lower than they are, but we're going to remember we had a freak occurrence of 0% interest rates for 2.5 years. Now we're in more of a normal environment, and this is actually more normal. It's a little higher than what we probably will end up with, but at these rates, our businesses do very well. And institutional investors around the world will want to put money to work in these products because they earn much higher than those base rates that are out there.
And your overall view of the economy right now, anything in particular concern you? I know there's been a lot of focus on Brookfield, for example. You mentioned in real estate and commercial real estate, office space being the main area. But beyond that, is there anything you see in terms of a warning sign?
Look, I just step back, and when you think about real estate, we invest out of two pools, and so we have a vast window on what's going on in the market. And pool number one's our opportunistic funds, and they're very transactional in nature. And assets, we buy them, fix them, sell them, and that's our business for clients. And we've done that for 20 years extremely successfully, and we continue to build that out. Then we have our pool of money in our corporation, which is we own assets forever, just like you or your family would own. And those assets are office and retail assets. They're the best assets on the planet. They're performing extremely well. And if you own great assets today, they're unbelievably good. But if you own poor assets, they're not. And there's a few of those that we had involvement with, but it's very small in relation to the size. I think, again, it was this interest rate situation that had everyone on notice. Now that that's stabilized, some people, yes, will have problems. Others will just work through in a normal situation.
Right. And so beyond that, you're fairly confident in terms of economic growth being available both here and around the world?
Look, I'd say the U.S. is where more focus is on problems. Globally, actually, things are pretty good. Yes, China's slowing a little bit, but they're still going to have 5% growth or somewhere near that this year. The rest of the economies around the world haven't had the same increases in interest rates as the U.S., but the U.S. has been pretty resilient. And I say that in a positive way because what we were worried about was interest rates were going to go up. There's still a lagging effect of some things coming through. We're going to bring interest rates down, and it's possible. It's possible that Goldilocks was achieved, is that we got out of this situation, which they had to do, which was pump money into the system, and we got out of this situation without causing economic stress.
Yeah, without causing widespread unemployment, for example, signs of which we don't see.
Correct.
At least not yet. You mentioned the Intel deal, and I wanted to talk about it a bit because, while it got some attention, perhaps not as much as deserved. And it's interesting because it's also still connected as well to another bill that came out of the U.S. Congress and the president's signature, which is the CHIPS Act. Why did you do the Intel deal where you're 49%, correct, of the equity in the fabs that they're planning on building?
Yeah, so again, going back to, you asked me, are we in control? Do we buy control? Do we only buy control? Our goal is to amass large sums of money on a global basis and provide it to entities that require it on a cost of capital basis that's good for them and it achieves our goals. And with Intel, they had a specific situation where they were building a plant and they wanted our money, but they wanted to control it and they wanted to be in control of what they were doing. And our capital facilitates that. And so every situation is different. And we're just here to facilitate assisting global corporations do things that they can't otherwise achieve without the capital that we bring from our own balance sheet and from our institutional friends.
Right. Well, to your point, though, I mean, Intel conceivably could have tried to go to the banks or to the public markets in some way, but the cost of capital might have been higher?
Look, it's given the structure that we created for them, it allows them to do more with our capital beside them than if they just built it themselves. It's said differently, they could do that with one or two fabs, but if their plan is to build much more, we bring extra capital to them. And so we continue to do that with, we just did a transaction in Germany with Deutsche Telekom, and we bought part of their towers in the country. It's not that they want to get rid of their towers, but they plan on growing that business, and therefore our capital helps facilitate them as beside them as a partner. Right. So sometimes we run businesses ourselves, and sometimes we become a capital provider to other
But I mean, the Intel deal, this is a long term. I mean, it's going to be years before we actually see any chips being produced by these facilities, correct?
Look, I think it's not that long. It's 4 years. I think we're up in 4 years. That may be long in some people's view. I think we're up in 4 years. The plant will last 2025. These are, remember, the things that we do. We're a business builder, and we build and we help people build things that are the backbone of the global economy. And as long as we can get the economics to work with our capital, then we're happy. We're happier to be in something for 25 years than earn a high return for 2 years. I'd rather earn less return and be in it for 25. if we
Meaning
can do
having 49% of the revenues coming from these plants that are going to be operating over that period of time.
Yes.
Right. So is there, I mean, are there, could you do more of these kind of deals?
Look, I think through many industries, we've done this for decades. Our renewables business, remember, if Amazon, who's one of our large counterparties in renewables, if Amazon wants to build renewables, they could build them themselves. But what we can do is help fast track projects, get them built, and provide capital to get it done. And so it's not like they can't do it themselves. It's just we can provide money and operating skills to be able to build out things and to help facilitate building out things.
Right. Well, speaking of facilitating, your money also can facilitate go privates. You also can be the principal behind them. Let's talk a bit about the go private market, leverage buyout market, if you want. You know, we all hear about all that dry powder. It's like it's been endless talking about it. What are your expectations, given the higher cost of capital for so many sponsors? Do they still go to work here, and are sellers adjusting to the new reality in terms of where they may actually be able to get a clearing price?
So just for context for your viewers, we put $50 billion to work, maybe more than that now, but over $50 billion to work in buyouts in the last 12 months. Very few people were able to do that, and we were able to do that because we have lots of dry powder, but also because we have a balance sheet and relationships with banks and a credit to be able to do it. And so we leaned in when the markets were at stress, and so we've continued to do business. Mm-hmm. It's been tougher for us, but for many even more, because there hasn't been a big financing market out there for buyouts. That is loosening up. There's no doubt it's loosening up today, but it will take time. But as I said earlier, with rates stabilizing, mm-hmm. you're going to see the capital markets recover.
So you're starting to see signs of that now?
No doubt.
You expect that the end of this year towards next year will be more active in terms of sponsor activity?
I'd say every week you see more activity. And so it's slowly coming back.
Mm-hmm. And that's your expectation.
Yes.
Slowly, but it will come back.
Yeah, no doubt. It's coming back, and but it's always slow. It always takes time.
Right. And the capital markets overall?
Look, I'd say the capital markets were tough. Most people didn't realize that they were tough in July of last year, so a year ago. People realized it in December. They were very tough until March, and they've opened up quite a bit. So I'd say every day again, and that's part of why are buyouts starting to happen, because credit markets are starting to loosen up.
Right. And when we talk about private credit overall, Bruce, and people say, well, the banks are being disintermediated, and that's just the way it is that a true statement? Are there opportunities for the big banks that typically, at least not that many years ago, used to finance so many things that now find their way into the private credit market?
Look, the banks are never going to get disintermediated. To the extent they have capital, they'll be putting it behind transactions, and they'll be in all of these things. And our view is we, with our insurance money, can partner with the banks to facilitate funding companies. And therefore, I think it's highly additive. Remember, what the Fed wanted to get risk off the banks' balance sheets. They created the private credit market. They created the CMBS market. They created the RMBS market. They've been highly, highly successful in pushing risk off the bank's balance sheets. And that's what it was designed to do. And it's been highly successful, and private credit's going to keep growing and growing for the next 10, 15, 20 years.
Yeah. And finally, as you head into an investor day, obviously many people in attendance or watching online are familiar with Brookfield, but there are going to be some who perhaps don't know the company as well, and our viewers perhaps may not. What is your message in terms of trying to help them understand this company, how you get to $2 trillion in assets under management in the next 5 years? Sort of what is it you're trying to communicate?
Look, the simple story about Brookfield is that we're trying to be a premier global wealth manager. We manage capital. We provide our services and skills to insurance companies, to sovereign funds, to individuals, and to other people that we can manage capital for. And we back it with our 140 billion of capital that we have in Brookfield Corporation. It backs $100 billion of insurance capital, which works beside us. And our $850 billion asset manager has an enormous army of people finding deals and servicing all those pools of capital. And we're trying to build one of the great businesses in the world for putting money to work to earn good returns with moderate risk.
Right. Good returns with moderate risk. That's the mantra?
Yes.
Does that differ at all from some of your main competitors?
Look, I think smaller, over time, we have, as you can imagine, enormous sums of money. And you can't try to always get the last nickel out of everything. So we like to earn high returns. Some of our strategies are the best of the best, and some are really good. Over time, they've been all excellent. But we make a few mistakes here and there, and everybody does.
But as I think you've said, you've made small mistakes, but no big ones.
Yeah, look, on balance, they've been really good, and you can't hit really, really high returns all the time. So our goal is never take too much risk, which means that we earn really good returns, but they're not super, super high, and we're not shooting for that. But what's really important is compounding really good returns over very long periods of time is an incredible thing. Compound wealth over time on top of each other is an amazing miracle of finance.
Right. Do you think people don't fully appreciate the power of compounding?
I think it just gets lost in day-to-day distractions of markets. And people don't focus enough on when they buy a security in the market, the price is one thing, the value is something else. And the value compounding over time is amazing. Eventually, the two will trade the same, but often it's like this. And use the public markets to your advantage. Don't let the public markets take advantage of you. Buy when value is lower than price. And just hold.
And
just keep holding.
Right. Okay. CNBC would be out of business in that world, by the way. But
I make no comments on that.
We're going to have to figure out a way to cover the private markets more effectively. Bruce, thank you for the time. I appreciate it very much.
David, thanks a lot.